What if international payments didn't require the dollar in the middle of every transaction? Not because someone decided the dollar should be replaced, not because of a political agenda, and not because a crypto project made a bold promise on social media, but because the mechanical architecture of global payments is genuinely inefficient, and that inefficiency has a cost that gets paid by every business, every bank, and every individual that sends money across a border. The correspondent banking system that currently handles the overwhelming majority of international transactions was designed in an era when physical settlement required days, when communication across continents took hours, and when the computational infrastructure to do anything more sophisticated simply didn't exist. That era ended a long time ago. The system it produced did not. And the gap between what global payments infrastructure currently does and what programmable financial networks are now capable of doing is where some of the most consequential developments in institutional finance are quietly taking shape. To understand why any of this matters, you need to understand how correspondent banking actually works, because most people who use it every day have no idea what happens between the moment they initiate a wire transfer and the moment it arrives. When a business in one country needs to pay a supplier in another country in a different currency, the payment doesn't travel directly from one bank to another. It travels through a chain of intermediary banks, each of which has a pre-established relationship with the next link in the chain. Each of those intermediary banks, called correspondent banks, maintains what are known as nostro and vostro accounts. A nostro account is essentially your bank's account held at a foreign bank, funded in the foreign currency, sitting there waiting to be used for transactions. The problem is that money sitting in a pre-funded nostro account is not doing anything productive. It is not earning meaningful returns. It is not being deployed in the economy. It is just waiting because the correspondent banking model requires liquidity to be prepositioned before it is needed. The global financial system currently has an estimated $150 trillion in annual cross-border payment volume flowing through this architecture. The amount of capital tied up in pre-funded nostro and vostro accounts to support that volume runs into the trillions. That is not a rounding error. That is a structural inefficiency embedded in the foundation of how the global economy moves money. And it has persisted not because no one noticed it, but because until recently, there was no credible technical alternative that institutions could actually deploy at scale. Ripple's on-demand liquidity product, which uses XRP as an intermediary bridge asset, is designed to address precisely this pre-funding problem. The mechanism works as follows. A financial institution that wants to send a payment from one currency to another doesn't need to have pre-funded accounts in the destination currency sitting in a foreign bank. Instead, it converts the source currency into XRP, transmits that XRP across the XRP ledger in seconds, and the recipient institution on the other end converts the XRP into the destination currency. The entire sequence, from initiation to settlement, takes seconds rather than the 1 to 5 business days that correspondent banking typically requires. The cost of the transaction is a fraction of what the correspondent banking chain charges in intermediary fees. And crucially, the capital that would otherwise be sitting idle in a pre-funded nostro account is freed up to be deployed productively elsewhere. The XRP ledger has been operating continuously for over a decade, processing transactions with a settlement finality that most blockchain networks cannot match at the speed and cost that institutional scale operations require. It is not a prototype. It is not a white paper. It is infrastructure that has been tested across real transaction volumes in real markets with real institutional counterparties. The on-demand liquidity product currently operates across 40 payout markets, delivers fee reductions of approximately 90% compared to traditional correspondent banking routes, and runs 24 hours a day, 7 days a week, without the settlement windows, cutoff times, and holiday closures that define the operational boundaries of the legacy banking system. The conversation around energy trade and the role of the dollar in commodity settlement is one that serious economists and geopolitical analysts have been engaged in for years, and it has intensified considerably as the global geopolitical environment has become more fragmented. The Petrodollar system, which emerged from agreements between the United States and major oil-producing nations in the early 1970s, established a convention by which global oil trade is priced and settled in US dollars. That convention created an enormous structural demand for dollars that reinforced the dollar's position as the world's dominant reserve currency and gave the United States significant economic and geopolitical leverage, as that leverage has been deployed more explicitly as a foreign policy tool, including through the weaponization of access to dollar-denominated payment systems. More countries have begun exploring whether alternatives exist. The discussions are real, the motivations are real, and the search for neutral settlement infrastructure that doesn't carry the political exposure of dollar-based systems is a genuine area of institutional and governmental interest. Whether XRP or any other digital asset ultimately plays a significant role in that evolution is genuinely uncertain. What is fair to say is that the characteristics that make XRP technically suitable as a cross-border bridge asset, neutrality, speed, low cost, and the absence of control by any single government or central bank, are precisely the characteristics that make it analytically relevant to that conversation. The path from analytical relevance to actual adoption at the scale of global energy trade is long, complex, and dependent on regulatory, geopolitical, and institutional factors that no one can fully predict. But dismissing the conversation entirely misunderstands the structural forces that are driving it. Ripple's institutional infrastructure build-out tells you something important about the company's strategic orientation that the daily price movement conversations entirely miss. Over the past several years, Ripple has moved from being primarily a payments technology company to building what it describes as a comprehensive financial services stack for institutional clients. The components of that stack include custody services for digital assets, which is the foundational infrastructure that institutional asset managers require before they can hold any asset in a regulated context. It includes Rlust, a dollar-pegged stablecoin that provides a stable value layer for transactions that need to move through the XRP ledger without exposure to XRP's price volatility. It includes tokenization capabilities that allow traditional financial assets to be represented on the XRP ledger in ways that make them programmable and interoperable with the rest of the digital asset ecosystem. And it includes treasury and liquidity management systems that help institutional clients manage the operational complexity of moving between traditional and digital financial infrastructure. Ripple executives have been traveling across 3 continents, visiting institutional partners and potential clients, building the relationships and demonstrating the capabilities that precede actual large-scale institutional deployment. The company holds 75 regulatory licenses and operates across more than 90 global markets. That is not the profile of a speculative project. That is the profile of a company that has made a long-term strategic bet on becoming infrastructure and is executing that bet systematically and at considerable operational scale. The growth of tokenized commodities on the XRP ledger represents one of the most concrete and measurable data points about the direction of institutional activity on the network. In under 3 months, the total value of tokenized commodities on the XRP ledger grew from $111 million to $1.14 billion, a 920% increase. The XRP ledger now ranks second globally for tokenized commodities, ahead of Polygon, Solana, Arbitrum, and BNB Chain, with approximately 15% of all on-chain tokenized commodities residing on the network. These are not speculative positions. Tokenized commodities represent real underlying assets, physical or financial commodities that have been represented as tokens on a blockchain, enabling them to be traded, transferred, and used as collateral with the speed and programmability of digital infrastructure rather than the settlement timelines of traditional markets. The institutions that are putting real assets on-chain are not doing so because they are enthusiastic about cryptocurrency. They are doing so because the operational advantages of programmable settlement are becoming too large to ignore relative to the costs of building and maintaining the technical infrastructure required to access them. When institutional capital arrives in a network in the form of tokenized real assets, it brings with it the demand for reliable, fast, and cost-effective settlement. That demand is exactly what a native settlement asset on that network is positioned to serve. The regulatory dimension of this story deserves careful attention because it is the variable that most directly determines whether institutional adoption can happen at scale or remains constrained to isolated use cases and pilot programs. Institutions operating in regulated financial markets cannot deploy capital onto infrastructure whose legal status is fundamentally ambiguous. They cannot custody assets, build products, or offer services to clients in contexts where regulators could subsequently characterize those activities as violations of securities law or other financial regulations. The resolution of the SEC's legal action against Ripple, which had created years of uncertainty about XRP's regulatory classification in the United States, changed the institutional calculus significantly. Goldman Sachs disclosing nearly $154 million in spot XRP ETF holdings by the end of 2025 is the kind of data point that reflects post-clarity institutional positioning rather than speculative exposure. Regulatory clarity does not guarantee adoption, but the absence of regulatory clarity almost certainly prevents it. The progressive clarification of the legal framework around XRP in the United States, combined with Ripple's established regulatory standing in jurisdictions across Europe, Asia, and the Middle East, has created the kind of environment where institutions can begin making longer-term infrastructure commitments rather than cautious, hedge-everything pilot programs. There is a persistent misconception about XRP's relationship to Ripple that is worth addressing directly because it affects how people reason about the asset's long-term viability and governance. Ripple does not control XRP. The XRP ledger is open-source software. The validator network that secures the ledger is operated by a globally distributed set of independent validators that includes universities, financial institutions, exchanges, and individuals around the world. Changes to the core protocol require approval from 80% of the validator network, and that threshold has historically been enforced even when proposed changes were opposed by Ripple itself. Amendments to the open-source technology have passed over Ripple's objection, which is the practical demonstration that the governance system functions as designed rather than as a Ripple-controlled mechanism. This distinction matters for institutional adoption because institutions evaluating infrastructure need to understand the governance model they are building on. A network that can be unilaterally changed by a single company is a different risk profile than a network governed by a distributed community of validators with meaningful checks on any single actor's influence. The governance structure of the XRP ledger, as it actually operates rather than as it is sometimes mischaracterized, is an institutional-grade feature rather than a liability. The question underneath all of this is not really about XRP's price or Ripple's valuation or which metrics are trending in any given week. The question is about what the financial infrastructure of the global economy is going to look like in 20 years and who is going to build it. The current correspondent banking system will not survive in its present form indefinitely. Its inefficiencies are too large, its costs are too high, and its architecture is too brittle for an increasingly complex and fragmented global economy. Something is going to replace it. The competition to determine what that replacement looks like, who controls it, and which technical standards it runs on is already underway. The institutions building that future are not doing so loudly or dramatically. They are doing it through procurement decisions and partnership agreements and regulatory engagement and infrastructure investments that accumulate over years into systems that eventually become too embedded to replace. If the future financial system is built on programmable infrastructure instead of legacy banking rails, the real question may not be which asset wins on any given day's price chart. It may be which networks become the infrastructure that the global economy actually runs on, and which ones turn out to have been building towards something real.